Okay, let's unpack this. Have you ever felt like you're just watching the minutes of your life tick by? Stuck in a job that feels draining, maybe under those fluorescent lights, trading your best hours for a paycheck.
Yeah, that feeling is, well, it's incredibly common. The source material we're diving into today, it starts right there. It really describes that sense of being disconnected, the anxiety about the next day, maybe.
Even feeling the stress physically.
Exactly. And it's not just a feeling people have in isolation. The source pulls in some data, like that 2017 number showing 70% of U.S. employees are disengaged at work.
70%. Wow.
Yeah, think about that. The vast majority of people clocking in are, well, they're doing it without real connection or motivation.
And meanwhile, you see those stats about how financially precarious things are for so many people. Almost no savings.
Right, one unexpected bill away from, serious trouble.
Yeah.
It paints this picture of a lot of folks feeling not just unfulfilled, but also pretty insecure in that traditional setup.
Right. And for decades, the script was basically get a job, work 40, 50 years, maybe retire in your 60s or 70s if you're lucky.
But the source points out that for many today, maybe especially younger generations, facing huge student loan debt or income that just hasn't kept pace, that old path, it feels less viable, maybe even less desirable.
Exactly. The material we're looking at really questions that whole narrative. It suggests maybe there's another way. A way that wasn't really even widely accessible maybe a decade ago, but is possible now.
Yeah, a different possibility.
So our mission in this deep dive is to pull out the surprising insights, the actionable strategies from this text. We want to explore this different path to financial freedom, help you understand the potential trade-offs, the possibilities it talks about for building wealth, and crucially, getting control of your time.
Which is really the key, isn't it? Time.
Absolutely. It's
Yeah.
about learning to look at money and work through a different lens, maybe one that feels a bit countercultural at first.
Okay, so let's start with the most fundamental idea the source puts forward. It's about reframing what money actually is. It's not this confusing, overwhelming thing that controls you.
Right.
It's just a tool. And like any tool, once you learn how to use it, you control it.
Okay, so that's the first big shift.
Yeah. And this is where they introduce what they call the enterprise mindset.
Enterprise mindset. Okay.
This is core. It's moving away from thinking like an employee just trading time for a wage and starting to think like an owner, like a business.
So constantly looking for ways to optimize.
Exactly. Make money work for you. Save, grow resources from every angle, like, successful business owners or investors do. Focusing on maximizing the value you get for every minute or hour you put in.
Whether that's working, saving.
Or having your money work while you sleep. That shift in perspective is huge.
And one of the most powerful ways they say to apply this mindset is understanding that saving money is making money.
Mm-hmm. Every single purchase is a decision, a trade-off. It's money that isn't being saved, isn't being invested to grow for your future freedom.
Which brings up that really interesting question they pose. How much do things really cost you?
Yeah, not just the price tag, but in terms of your life, your time.
This is where it gets pretty compelling, actually. They suggest calculating your real hourly rate.
Okay, how does that work?
Well, you start with your after-tax pay, right? But then you subtract all the unpaid time related to your job.
Like commuting, getting ready.
Exactly. Commuting, getting ready, maybe answering emails off hours, even the time you need to de-stress when you get home.
Wow. Okay.
The source mentions the average American commute is nearly an hour a day.
Yeah.
That adds up. It's like working an extra month a year, unpaid.
Jeez. So your actual take-home per hour worked is way less than you think?
Right. So if your after-tax pay seems like, say, $30 an hour before all that, once you factor in the unpaid stuff, your real hourly rate might be closer to $20 or $25.
Okay.
Now think about buying something big, like a $60,000 car. At that real $30 an hour rate, you're trading 2,000 hours of your life.
2,000 hours?
Yeah, at 40 hours a week, that's almost a full year of your working life just for that car. When you frame it like that, it hits different,
It really does. And you mentioned taxes, too.
Oh, yeah, taxes have a huge impact. That's a $3 cup of coffee. If you're in a 25% tax bracket, you actually had to earn $4 before taxes to have the $3 left over.
Wow. Okay. Because $1 of that went to tax first.
Exactly. So a $40,000 car in that same bracket means you had to earn over $53,000 pre-tax. It just dramatically increases the real-time cost of everything.
Which highlights what they call the convenience costs.
Right. The source uses that example of a $60 steak dinner out. That same steak might cost, what, $15 at the store? The markup is huge, like 400%.
You're paying a massive premium for someone else to do the work.
Is that convenience always worth trading the hours it took you to earn that extra money? That's the question they pose.
And on the flip side, they talk about buying used.
Yeah, finding like $100 shoes for $19 on eBay. It's not just saving $81.
It's saving the time it took to earn that $81 after tax.
Exactly. They encourage you to really analyze your regular spending. What are you buying just for convenience or out of habit? What's the real-time cost?
Now, this isn't about like extreme deprivation, though.
Yeah, well, not at all. The author's clear on that. It's about finding the spending level that genuinely makes you happy.
Okay.
They found cutting back on travel and eating out wasn't the huge sacrifice they expected, because the bigger goal, freedom, was more motivating.
So it's about intentionality, aligning spending with your values, not just mindless consumption.
Precisely. And as you get more intentional with saving, the source frames tracking your net worth, your assets, minus liabilities, as keeping score.
Like a game.
Yeah, the money game, they call it. Watching that number grow, especially with compounding, they say can become really motivating. Almost addictive, but in a good way.
I can see that. And they mentioned tools for tracking it.
Yeah, various tools you can use.
Okay, so speaking of liabilities, debt. What's the take there? Because often you hear pay off the smallest debt first.
Right, the snowball method for psychological wins. But this source challenges that a bit. They argue you should strategize debt repayment to maximize your ability to save and invest as quickly as possible.
So maybe not always the lowest balance first?
Potentially not. It might mean paying a bit ahead on some debts while also putting extra cash into investments, especially if you think the market gains could outpace lower interest debt.
Interesting. So optimizing the whole picture, not just the debt part in isolation, and building that investing habit early.
Exactly. But there is one rule they stress is absolutely non-negotiable.
Which is?
Always, always, always take the full company 401k match.
Ah, the free money.
That's what they call it, free money. It's an instant 50% or 100% return, depending on the match structure. Rule number 1, never leave free money on the table.
Makes sense. Okay, so money, investing, can bring up a lot of emotions, right? Fear, maybe.
Definitely. The source shares the author's own story of seeing the market dip and freaking out, thinking they'd lost $10,000 in a week.
Oof, yeah, that's scary.
But the key insight is remembering a market dip isn't a realized loss unless you actually sell.
Right. Stay calm, play the long game. Markets fluctuate.
Exactly. And compare that fear of, say, market volatility with the certainty of losing purchasing power if you just keep cash in a savings account.
Because inflation eats away at it.
Right. Savings accounts rarely keep up with inflation. Investing involves calculated risks, yes, but it's designed to outpace inflation long term. Getting comfortable with that is part of mastering money.
Okay. And managing those emotions, staying on top of things, that links to daily habits.
Yeah, they suggest just 5 minutes a day. Check your investments, look over credit card charges, make sure you haven't missed any payments owed to you.
Just 5 minutes.
Yeah, make it a small, consistent habit. It builds familiarity, reduces anxiety because you know what's going on, and helps you spot issues or opportunities quickly.
And they mention maybe slightly deeper weekly or monthly reviews too?
Briefly, yeah.
Yeah.
Manually paying bills or looking at your cash flow to see where the money's actually going.
Got it. Okay, so that covers the mindset shift, the enterprise mindset. Now, what about the engine that really speeds things up?
Ah, right. That's the savings rate.
Savings rate, defined simply as?
Total amount you save divided by your income. And its role is, well, absolutely critical.
They say the higher your savings rate, the faster you reach financial independence, almost no matter your income.
Pretty much. The examples they give are really striking.
Like who?
Well, an attorney named Anita saved 85% of her income, reached FI in just 5 years, by age 33.
85%. Wow.
Yeah. Or Steve and Courtney saved 70%, FI at 35. Someone named JP saved over 80%, hit FI at 28 with over $2.5 million.
Okay, those are powerful examples. It really highlights the impact of saving aggressively.
Totally. And the source refers to charts that show this relationship visually. Income, spending, and the years to FI.
So while earning more helps, the rate is the key lever for time.
Exactly. Going from saving, say, 10% to 30%. Cut your time to FI way more dramatically than just getting a raise if your spending creeps up too.
Okay, so how do you boost that rate?
They suggest a hybrid approach. Automate a big chunk right after payday.
Set it and forget it, kind of.
Yeah, but then also make manual efforts. Add more throughout the month, invest bonuses, all your side hustle income, maybe increase your contribution by just 1% every couple of months.
Incrementally nudge it higher.
Right. And they make an interesting point psychologically.
What's that?
Getting from 0% saving to around 20% is often the hardest part.
The initial leap.
Yeah. But once you hit that 20% consistently, see the money grow, see the compounding, the motivation really kicks in. Pushing higher to 30, 50, even 70% plus becomes more achievable because that goal of freedom feels more real.
Okay, so saving aggressively is the engine. How do you get more fuel for that engine? Making more money, presumably.
Exactly. Which leads to the next big section, making more money. Two key areas here, optimizing your salary and side hustles.
Right, start with the main job.
Yeah, maximize that salary first. The material points out, look, companies are set up to make money off employees, and they know it costs a lot to replace you.
Tens of thousands, potentially. That's leverage.
It is. Which brings up the question, do you know your market value?
How do you find that out?
They strongly recommend research. Use Glassdoor, talk to recruiters in your field, find industry salary reports, know what people with your skills are making in your area.
Okay, market value, and then your value to the specific company.
Right. What problems do you solve? What revenue do you bring in? What costs do you save? Quantify it if you can.
And use that data to negotiate.
Exactly. Ask for a raise. They suggest maybe asking in percentages seems less jarring sometimes.
Yeah.
And timing can matter. Maybe Friday morning is better than Monday. Little psychological things.
Yeah, interesting. Any examples?
Yeah, they share a couple. Brian, an IT guy, jumped from 42K to 90K just by using recruiters to find a remote job.
Wow, huge jump.
Or Victor in sales. Went from 45K to 125K after he realized his market value and showed the $1.5 million in new business he'd brought in.
Okay, so knowing your worth and asking for it pays off. Literally.
It can, yeah. The source also briefly touches on equity compensation stock options, RSUs.
Right. Common in some industries, especially tech.
Yeah. They suggest viewing it as a potential future bonus, not guaranteed money.
Evaluate it like an investor would.
Exactly. Do you believe in the company, the leadership, the growth potential?
Yeah.
Especially important if you're an early employee where it could be significant.
Oh, okay. So optimize the day job, side hustles.
Yep. Presented as a really powerful way to boost income on your own terms and potentially build an actual asset.
An asset, not just trading more time for money.
Right. That example of Matt, the graphic designer, is pretty wild. Making 55K at his job.
Yeah.
But ended up making $200,000 a year from a dog walking side hustle. He started way back and just scaled up systematically by hiring people.
200 grand from dog walking. Okay, that's just the potential.
It does. But the big question is always time, right? How do you find time for a side hustle?
Yeah, if you're already feeling stretched thin.
The source suggests leveraging found time, especially mornings, maybe just a couple of focused hours before the day gets crazy.
Or little pockets of time during the day.
Yeah. It requires being really intentional, focusing only on the high ROI stuff for the side hustle, learning to say no to distractions.
Makes sense. And ideas. Everyone has ideas.
True. Ideas are easy. Execution is hard. They suggest brainstorming, sure, but then picking just one or two to really test and develop.
Focus is key.
And there are specific strategies they mentioned for making a side hustle work well.
Like what?
One is niching down. Become the expert in a super specific area.
Oh, yeah.
They mentioned Trevor, a marketer who only does marketing for Canadian orthodontists.
Mm-hmm.
Super niche. Allows him to be the go-to, charge premium rates.
Ah, interesting. What else?
Building relationships and selling into existing communities, where people already know and trust you. Your network is often your first customer base.
Right. Leverage existing trust.
And crucially, maximizing perceived value.
Perceived value. How does that work?
It's not just about the hours you put in. It's the outcome you deliver and how the client sees that value. The author gives an example.
Yeah.
Building a $500 website for a small firm, then using basically the same template and process to build a $50,000 website for a huge firm.
Wow. Same work, vastly different price.
Because the perceived value to the larger client, the potential impact for them, was way higher. Allows for totally different pricing.
So thinking about pricing models beyond just hourly rates.
Definitely. Value-based pricing, maybe even profit sharing in some cases, can really boost income potential.
Okay. And if the side hustle grows, you run out of time yourself.
Then you scale by hiring. Start with contractors maybe, test the waters. Then eventually employees.
So you shift from selling your time
to managing and brokering other people's time. That's key for scaling beyond your personal capacity, increasing efficiency.
Got it. Okay, so mindset shift, saving aggressively, boosting income. It all feeds into the final piece, right? Investing, putting the money to work.
Exactly. Investing the income you earn and save. They call this the ultimate passive income stream.
How the wealthy really build and maintain wealth.
Yep. And the emphasis is on investing early and often
Yeah.
because of compounding.
That magic of compounding growth. A dollar invested today has way more time to grow.
Right. And a dollar not invested is losing value to inflation. It ties back to that enterprise mindset, seeing every dollar as a potential employee you can hire to make more money for you.
Okay, so how do you actually manage the investments? DIY or get help?
The source says you can totally do it yourself. They estimate less than an hour a month once you're set up.
An hour a month? That's manageable.
Or you can hire help. But they have a very strong recommendation here.
Which
If you hire an advisor, make sure they are a fee-only fiduciary.
fee only and a fiduciary. Why is that so important?
Fiduciary means they are legally required to act in your best interest. Fee-only means they get paid a flat fee or hourly rate, not commissions for selling your products.
Okay, so their incentives are aligned with yours.
Right. Avoid advisors who earn commissions or charge based on assets under management, or AUM.
That percentage fee, like 1%.
Yeah, it sounds small, but over decades, that 1% compounds against you. It can cost you hundreds of thousands, even millions, in lost growth compared to managing it yourself or paying a flat fee.
Wow, okay, that's a huge difference. What about an emergency fund? Still 6 months of expenses in cash?
They acknowledge that traditional advice, but offer some flexibility. Depends on your situation, job security, other income streams.
Because cash loses value to inflation.
Exactly. So maybe slightly less cash if you're super secure, and perhaps use bonds for shorter-term needs. They usually offer a bit better return than cash, but are still pretty stable.
Okay. Asset allocation then, stocks versus bonds. How do you decide that mix?
It should align with your time horizon when you need the money and your comfort with risk.
So younger, further away from needing it, more aggressive.
Generally, yeah. Maybe 100% stocks if you're 10-plus years out, because you have time to recover from dips. As you get closer, you shift to more conservative, maybe 60-40 stocks bonds to reduce volatility.
And that's the total allocation across all your accounts, right?
Look at the whole picture.
And what kind of investments?
They strongly recommend primarily low-fee, tax-efficient index funds.
Index funds. Okay, break that down quickly.
Sure. An index fund pools money to buy a broad basket of stocks or bonds that just tracks a market index, like the S&P 500 or the total U.S. market.
So instant diversification, low effort.
Exactly. And because they just track the index, no active managers picking stocks, the fees expense ratios are super low, crucial for long-term returns. And they're usually tax efficient, meaning fewer taxable events inside the fund.
Got it. Low fee index funds. And where should you hold these investments?
Priority number one, max out your tax-advantaged accounts first.
401k, IRA, HSA, maybe FSA.
Right. These offer huge tax benefits deductions now, tax-deferred growth or tax-free withdrawals later. Plus, that employer match is only in the 401k. Never skip those advantages.
Makes sense. They mentioned traditional versus Roth choices.
Briefly, yeah. Traditional is pre-tax in, taxed on withdrawal. Roth is after-tax in, tax-free growth and withdrawal. They also mentioned strategies like the Roth conversion ladder for potentially accessing funds early in retirement, penalty-free after waiting periods.
Okay, complex stuff, but good to know about. And after maxing those out.
Then you invest in regular taxable brokerage accounts.
And the advantage there?
Long-term capital gains tax rates. If you hold investments for over a year before selling, the profits are taxed at lower rates than your regular income.
Lower tax is always good.
And here's a really fascinating point they make.
Yeah.
Depending on your total taxable income in retirement, your long-term capital gain rate could actually be 0%.
0% tax.
Seriously. Yeah. Based on the numbers they provided, if a married couple's taxable income is below a certain threshold, currently around 75-80K, they might pay 0 federal tax on those capital gains from a taxable account.
Wow, that's huge.
It really is. And they give a general order for withdrawals in retirement,
Which is usually.
often drawing from taxable accounts first to take advantage of those low or 0 rates, letting Roth accounts grow tax-free the longest.
Okay, so stocks, bonds, index funds. What about real estate?
Yeah. Real estate investing is presented as another potentially powerful strategy.
Why powerful?
Leverage, mainly. using OPM, other people's money, through mortgages.
Mm,
You control a big asset with a relatively small down payment.
right, like 5% down sometimes.
Exactly. And house hacking.
Buying a duplex, renting out rooms.
Yeah, that can generate cash flow to cover your mortgage. You could live for free or even make money while building equity.
Plus appreciation over time.
Right. Historically, 3–5% a year maybe.
Yeah.
But because you use leverage, that appreciation's on the full property value, so your equity grows faster.
And they talk about refinancing to pull cash out.
Yeah, refinance, pull out equity, use that as a down payment on the next property. Build a portfolio over time.
Sounds powerful, but maybe complicated.
It takes work, for sure. They offer tips. Focus on cash flow, find good neighborhoods, understand timing, use good agents and inspectors.
Okay, so tying it all together, once you reach FI, how do you make the money last?
Crucial point. Try to live off side hustle income, passive income, or cash reserves for as long as possible before tapping the main investment principal.
Why is that so important?
To minimize sequence of returns risk.
Sequence risk. The danger of bad market returns early in retirement.
Exactly. If you're forced to sell stocks when the market's down just to pay bills, you lock in losses and have less capital left to recover.
So you use cash or bonds during downturns.
Ideally, yeah. Or alternative income. Only sell stocks when the market's up, if possible. It preserves your principal so it can keep growing long term. Best case, your other income covers everything, you never touch the principal.
Wow. Okay, so bringing this all back, what's the big picture message from this source?
I think it's that mastering money is the means, but the real goal is time.
Time, yeah. Time for joy, family, health, passions.
Exactly. And it's not about just grinding forever. They stress balance, chill as hard as you hustle to avoid burnout,
That's important.
and defining success on your own terms. Being honest about how much money you really need for a life you love, not what society tells you you want.
Don't just inflate your lifestyle because your income goes up.
Right. And ultimately, life, like investing, it involves calculated risks.
Overcoming fear to pursue growth.
Yeah. Money, when you master it, gives you the freedom and security to take more of those calculated risks, pursue bigger opportunities on your terms.
So this deep dive, it really lays out a path, questioning old norms, that enterprise mindset.
Focusing intensely on the savings rate, boosting income, investing strategically.
It all comes together.
Yeah. Ultimately, this knowledge, it empowers you. It lets you master money, not be controlled by it. Gain control of your time, worry less, create more opportunity.
Opportunities you might not have thought possible before.
Exactly. So if time really is the ultimate goal, this whole discussion leaves us with a final thought for you, the listener.
A provocative one.
I think so.
Yeah.
What calculated risk are you willing to take today to gain more of that precious time in the future?